In this video, I'm going over the Chapter 7 Problems P2 and the tax return for Chapter 7. And they're going to be smaller assignments. For Connect for problems, there's only this problem and one other very small problem, which is very similar, just to give you some extra practice. And then for the tax return assignment for Chapter 7, you're going to head into Laulima and you're going to report these three assets, this problem, which I'm going to go over in this video. You're going to report these on the tax forms, Form 4797 and Schedule D. And I'm going to cover all of that in this video. So first, let's zoom in here and read the problem. So we have three assets: a warehouse, which cost $135,000, which we acquired or bought on 10/10/10. We took depreciation of $23,220, and then we have a sale price of $156,750, and our sale date here in 2017, about 7 years later. Then we have a truck, cost $20,000, purchase 1/15/2016. We've taken $7,200 of depreciation, the sale price, and our sale date of 1/14/2017. So pay attention to those dates. And then the computer, $22,000 cost, our date acquired, our depreciation, our sale date, and our sale price. So our first question for the warehouse: what is the adjusted basis? We know that's cost minus depreciation equals the adjusted basis. So all we need to do is insert the numbers, right? So our next question for the warehouse is, what is the realized gain? Remember, realized gain is just the actual gain, sale price minus adjusted basis. And then recognized gain refers to the loss. However, our book really doesn't get into that, unfortunately. They don't really use that terminology, so you don't have to worry about it, but just understand that difference. So let's pop in the numbers for our realized gain. We use that adjusted basis amount and subtract it from the sale price, and there we have it, $44,970. Now they ask for the third question: what amount of the gain is taxed at Section 1250 rules? Well, they're giving it away, right? This is Section 1250 property. All three of these assets are used in the business, so they're all starting out anyway as our third category of asset, right? But specifically, Section 1250 is one of those subcategories that applies to assets that were depreciated, which is Section 1245, and then for real estate, Section 1250. So remember, these sections underneath the Section 1231, they are related to recapturing depreciation, and they're based on the amount of depreciation that was taken. So how much depreciation was recaptured? If our gain is more than all the depreciation that was taken, then we recapture the full amount of depreciation. And they don't mention it here, but what is this taxed at? It's max taxed at 25%. So if someone's in a lower income tax bracket, they pay the lower percent. But if someone's in a higher tax bracket, the tax on this Section 1250 recapture will be maxed out at 25%. And the last question here, I think, can confuse people. What amount is considered a Section 1231 gain? And you could really stop the question there, right? What amount is considered a Section 1231 gain? Because remember, technically it's a net Section 1231 gain. You add all of the gains and losses that qualify as Section 1231. And so basically, we need to do something with the rest of the gain beyond the $23,220. What happens to that gain? It's Section 1231 gain, and it gets netted together for our second main category, capital gains, and it's taxed at capital gain preferential rates, that net Section 1231 gain. Remember, if it was a loss, it would be fully deductible. On the other hand, so that's why it's called net section 1231 gain, because only that gain is treated as capital, or that second special category for investment in personal use assets. And on the other hand, if it was a loss, it's fully deductible, whereas capital losses are only deductible up to $3,000 per year. The rest can be carried forward though. On to our next asset, the truck. So the first question, what is the adjusted basis? Our cost minus depreciation equals our adjusted basis, 12,800. Number two, what is the realized gain? Take our sale price minus that adjusted basis, 5,850. Now, number three, what amount is taxed according to Section 1245 rules? So remember, this is an asset subject to depreciation recapture. As long as it's not 1250 property, which is real estate, then it's Section 1245. However, because this asset was held short term, shy of 2 days, it becomes that first main category, our ordinary income category. And so any gain is taxed at the ordinary income rates. And you'll see this on the tax forms that it goes straight to being taxed as ordinary income, no preferential treatment. And if it was a loss situation, it is not treated as that first category. Instead, it's just not deductible. On to our last problem, the computer. So the first question, what is the adjusted basis? Our cost minus the depreciation, 14,170. Then number two, what is the realized gain or loss? So we take our sale price at 12,760 minus that adjusted basis we just calculated, and we have a loss of 3,410. Then we're on to the last question. What section code applies? It's tempting to want to say Section 1245, right? Because it's depreciable property, recapture applies. It's not real estate, so it's not Section 1250, but we have a loss. So can there be depreciation recapture when we have a loss? No. So therefore, it's just Section 1231 property because it was held long term. So Section 1231 loss. So when you're ready to start updating your Form 4797 in Schedule D, you come over to Google and you do a search, Form 4797. And I'm going to show you how to download and update these forms so that you don't lose your work. And this is a skill you should know how to do. So I'm going to press Command and open this form up in a new tab. Here it is. Now you'll also need Schedule D, so you just search Schedule D. They'll come up first. Use the most recent forms because, I mean, you might as well. There's not that much of a difference, especially in these forms. Hardly anything has changed, so you might as well be up on the latest form. And I'm showing you how to do it anyways. Okay, so now when you get to the actual forms, from here you must, if you start typing in, this isn't going to save and you won't be able to submit it to me. So what you need to do is you need to download like this and save it as something. I saved mine as Chapter 7 tax return. I'm going to cancel because I already did it, but then I'm going to show you. Then I come over to my Finder and I search Chapter 7 tax return. Search the name and oh, here it is, TR. I abbreviated it. And then you just double click that and it will open. This is a reader. I don't even have Adobe on this computer. Now this is where you need to start typing and then go File, Save, and it's just going to save. So now we're going to close it to make sure it's saved. Come back over here. And see it's saved. So that's how you save, okay? No excuses. You got to follow those steps. Now, some other things that you might find really useful if if you want to do it quickly, you could do it quickly, but if you take your time and read through the forms all have instructions. However, you will need some other information, like Form 4797 instructions, see these, and then Schedule D instructions. And if you get into the instructions, because you'll notice the forms a lot say refer to the instructions, you'll be like, oh my goodness, this is hardly providing any information at all, even though it provides so much information. So much of it is just referring to more complex things, but there's a lot of nice tables, there's a lot of worksheets. The Schedule D, you actually use this worksheet for the schedule section 1250 unrecaptured 25% gains, which in our case it's just very straightforward. It's not really it's just the number that ends up carrying over, so it's not that big a deal because nothing else applies. But these things are really complicated, and so there's also a publication, which these are called IRS pubs, and you can see, look at that whole list there. Those are all IRS pubs, and we'll do gains and losses. Pub 554, sale and other disposition of assets. And I'll tell you, there's always two options with these pubs. There's one that's online, and then there's one that's a PDF. See at the end here it says .pdf. I prefer the PDFs, and most people do, because you can search them. You press Command F, and then you can search in here and find the things you want quickly. This is a better place to go to learn about everything we learned about in this chapter, really, than the instructions. Now, you do have to use the instructions, but you can use them combined with this. And you see here, we have general gain or loss. Then we have ordinary or capital, which we covered, and then our business, capital, ordinary or capital or our business. So all of that is covered here as well. Okay, lastly, let's go over the forms 4797 and Schedule D, which you'll submit for the tax return assignment for Chapter 7. Now, we already went over how to download the forms. Now we'll go over entering this problem onto these two forms. So, sale of business property. All three of these assets were business property, so we're only dealing with Form 4797 for the actual detail of these transactions. However, there are three sections to Form 4797, and I really liked that this problem got to use all three parts. So first of all, we have Part 1, which is for business property used more than a year. However, many assets are not reported in this section because if they have depreciation recapture, they go in Part 3. So when don't we have depreciation recapture? When don't Section 1245 and Section 1250 apply? Well, assets that are used in business for more than a year that aren't depreciated. Well, there's only one of those, and that's land. But what is the other situation? It's if we have a loss, right? If we have a loss, then we don't have to recapture depreciation. We only recapture depreciation to the extent that there is a gain on the sale. So the computer was a loss. So the computer is reported here in Part 1. You can pause this to take a closer look, but all of that information just reported there. Now, then we'll zoom to the back of the form. So our warehouse, which had depreciation recapture, Section 1250 property, is reported here. And these assets are reported like this. Horizontally versus the perpendicular on that part of the form. So as you fill out here the first property, you can say gross sales price. See line 1 before completing. So if you look at the instructions for this, basically the forms are trying to incorporate more of a catch for a check, to be able to check different forms. And if you read the instructions, it explains more, but essentially you'll see this first line right here, number 1 at the very top here, and that's saying report any amounts on line 2, 10, or 20. You follow the form as normal. This is like a separate thing. Any amounts on those lines that were reported to you on a Form 1099-B, which would be fairly uncommon, or a 1099-S, which would certainly be more common, then include that total amount here. And that's how they're checking that people are reporting the forms that are given, just like the IRS does very easily with a W-2 form, right? Businesses file W-2s, and so if people don't report a W-2 with their taxes, the IRS has that information already. Okay, so continuing down, then we have cost or other basis plus expense of sale. So that's our cost basis. Depreciation, that's our depreciation amount. Adjusted basis, that's what you already calculated. Total gain. Now, this is not Section 1245 property. This is Section 1250 property. Why is there nothing here? Do you remember? I know I breezed over this. Basically, in the past, you were not required to take straight line depreciation on a building. And so there was an additional adjustment to this depreciation amount for recapture. But remember, in our situation, we already went through this problem. The 1250 recapture was this exact amount, because this rarely applies since most buildings now take straight line as their normal type of depreciation. So then down here at the bottom, line 30, total gains for all properties A through D, line 24. So that is this line right here for all the properties. And if you have more properties, you just add more copies of this. And then add property columns A through D. These lines, enter it here. Subtract that out. And so that becomes our total amount, that $44.97, our total for gain. And so that comes over here. Gain, if any, from line 32. And so that gain comes over here and is netted with our loss, because both of these, the gain and the loss, right, were for more than a year. Property use in the business held more than a year, so they are netted together. And that brings us to a net $41,560. Now, we will account for that section 1250 tax up to 25%, at a maximum of 25% on that depreciation on Schedule D. Part 2, ordinary gains and losses. So what does that mean? How do they become ordinary? It was held for less than a year, like our truck, and so that is reported here. You can follow the same headings as up here, down here. And here's that gain we calculated, which gets combined on line 17 and then transferred to a total on 18B. And you can see this amount is not going to go to our Schedule D. Schedule D is a summary of capital gains and losses taxed at the preferential rate or capped at other rates for recapture. However, because this is an ordinary gain or loss, since it's a gain, it's taxed at ordinary rates on Form 1040, and so it tells us to go directly to Schedule 1, Form 1040, line 14, to be taxed at regular rates. Lastly, we'll come over to the Schedule D, and gain, see line 11 right here, we have gain from 4797 Part 1. And then it's listing other places. So it's saying amounts from all of these places get totaled here. But the one we care about is gain from Form 4797 Part 1. And there's our total, 41,560. So that was the net of our long-term loss and then the total gain. They get combined together and netted on the final line 15. And remember, for our short term, there's no amounts here. And then we come over here, combine lines 7 and 15. So 7 is that short term, we have nothing, so we just have the gain, so it comes here. Then it says, if line 16 is a gain, enter the amount on line 16, Schedule 1, Form 1040, line 13, or blah, 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 and then go to line 17. If it's a loss, you can read through. If it's 0, you can read through. So we are going to enter this amount on line 13 for those preferential rates. However, if you are required to complete the unrecaptured Section 1250 gain worksheet, enter the amount, if any, from line 18. And when you fill out that worksheet, which you'll find in the Schedule D instructions on page 14, it's basically just this number repeated a bunch of times. I would recommend taking a look at it just to see. It can be quite confusing, and so you could really get a feel for what can sound simple in a calculation versus reading these forms. There's so much being accounted for. So this is, since they were both gains, we check yes here, right? And we don't have any 28% gains. We only have the 25% gain amount. So we break this out here and it's calculated on the return. So this is reported as a whole number, but this amount is broken out for the tax calculation.